Hello everyone, this is John Kogan. I'm the CEO of Proformative, the online community for corporate finance, accounting, treasury, and related professionals. I would like to welcome everyone to today's webinar entitled Finance Transformation, Essential Elements for Driving Success. Finance transformation efforts are proliferating as CFOs seek to improve their organization's decision support capabilities and boost process efficiencies. But what does it take to get from point A to point B? To evolve the finance function at a large, complex organization into an effective business partner. It is neither intuitive nor easy, and it's fair to argue that the majority of large organizations have more work to do. In today's webinar, Mary Driscoll, our speaker, who I will introduce momentarily, will discuss APQC's new report on financial management best practices. In this webinar, you will learn how leading finance teams plan and pursue function-specific improvements on a global scale. You'll see how process management methodologies such as Kaizen and Lean Six Sigma can be used to govern financial management change and keep momentum going over the long run. Before we get started, a few items. Number one, welcome to Proformative. To those of you for whom this may be your first Proformative event, we welcome you today. A little bit about Proformative. We're the largest and fastest growing online resource for senior level corporate finance, treasury, accounting, and related professionals. We're a peer-based resource, predominantly, where corporate finance and related folks can connect with one another via our peer network, can ask questions, contribute answers, and share invaluable resources and features that have been collected both by the website and by their peers. All of it is completely noise-free. There are no ads on this site. No one's allowed to self-promote, so it's genuinely a safe place for us to ask questions and share knowledge with one another. Please do check it out at Proformative.com if you have not already. A few notes on today's event. Links to today's presentation and to the recording of this webinar will be sent out to all attendees within 24 hours of the event. The presentation is already posted and available at www.proformative.com/resources for a free download. So if you'd like to download it, take notes, follow along as we go, other than on the screen, that's a great way to do it. It's already out there, and you can grab it. We are offering CPE credits for today's event. You will need to have pre-registered for CPE credit. We will be asking 3 polling questions during today's event, one during the presentation, one just after the presentation and before the Q&A, and then one at the very tail end of today's webinar. So please stick around for the full event to answer all 3 CPE polling questions. If you have any questions at all about CPE credit, please contact Chris Brower, and her email is right there. Now, we would like this to be an interactive experience, and as I noted just a moment before, we have a presentation followed by a Q&A session. So the Q&A session will be the last 10 to 15 minutes of today's webinar. We would love to have your questions on board, so please feel free to take a quick look at your GoToWebinar control panel. You'll have a little section there called Questions, which you may have to hit the plus by to expand. Please do ask questions at any time. We'll queue them up, and then we will ask Mary to address them when we get to the Q&A portion of today's event. At the end of today's event, after the final polling question, we do ask that you stick around and give us 1 more minute. There's a short survey on the back end of this webinar. We like to get your feedback and know what you liked and didn't like, what we can do better the next time. Also, if you'd like to be connected with Mary after today's event, we make it very easy to make that request in the survey. So it's just a click of a mouse, and then we will happily put you together with Mary via email. So that's all in the post-event survey, which takes just 1 minute. Now we have a few learning objectives in today's event, and after participating in this event, we'd like you to better understand the strategic purpose of the finance function. We'd like you to learn how to best leverage talents and optimize your company's finance organizational structure, and understand how best-in-class finance departments measure performance and optimize communications. So we've got quite a bit on the agenda today, and to help us get on top of all of this great information and learning, it's my pleasure to introduce Mary Driscoll, who is a Senior Research Fellow at APQC. Mary is an author, editor, and lecturer with expertise in corporate finance, capital markets, and business management. She serves as Senior Research Fellow at APQC, a benchmarking and best practices research organization. Mary leads the Financial Management Research Initiative there. Previously, she spent a decade as President of CFO Research, the research services arm of CFO Magazine. Prior to that, she spent 7 years as Senior Editor at CFO, developing features on topics ranging from financial risk management and capital structure to leadership development. Before joining CFO, Mary held editorial roles at Thomson Financial Services and Fidelity Investments. Mary has written several business books, including the Professional Reference Guide entitled Cash Management, Corporate Strategies for Profit by John Wiley & Sons. She has won journalism awards for corporate finance, treasury, operations, and personal financial planning topics. She currently serves on advisory boards for 3 technology startups. And with that, Mary, thank you so much for joining us today.
Well, thank you, John, and thank you for that very extensive and kind introduction. And thank you to everybody who has taken time to share with us today. I'm going to be presenting information that is drawn from a variety of research programs that I've been conducting over the past 6 to 9 months that aim at the big question of finance organization transformation. Now, as you can see on the slide here, we launched a survey as a precursor to what we call at APQC a best practices research program. And the survey drew responses from 145 mostly large U.S. and European corporations. This was a startling finding to me. I have been looking at this issue for 15, 18 years or so, and in fact wrote a major report called Finance Transformation with a 3-part series back in the late 90s. And so I'm kind of startled that, number one, why are we still talking about this today? And you'll see when we get to some of the subtext that the conversations have not changed as much, and I find that very curious. But in this survey, we found that 8 out of 10, a little over 80% of companies answered positively when asked if they were investing in a major transformation program. Now, whether you call it transformation or a major improvement initiative really doesn't matter that much to me. I think people use the phrases, you know, in a variety of ways. Consulting firms tend to use the word transformation. CFOs don't. Be that as it may, we defined a major program as one that was involving at least 2 of the following elements. Okay, so it had to involve big IT applications, you know, that were designed to strengthen business analysis. Process streamlining was another indicator of a major program. Major process streamlining really intended to boost labor productivity, or process automation. And we're going to talk a little bit about what are the more common applications I'm seeing these days, such as AP automation. We'll talk about that in a little bit. So, you know, if someone had a process automation program going on to speed cycle times or reduce costs, that counted. Also looking at if anyone had an enterprise-wide effort to standardize accounting and reporting, or finally a concerted effort to develop finance talent. So the fact that 8 out of 10 organizations are now pursuing major process improvements is significant, I think, for 3 reasons. You know, first, we had the global financial crisis, and prior to that, CFOs were, by and large, mainly interested in incremental process improvement to save money. The slogan was very much do more with less, summed up by the general, that really much summed up the general attitude. So what's behind the surge? Let's see if I can get this to toggle here. There we go. What's behind the surge? Well, from what I can tell, and this is my sense drawn from conversations with finance executives, as well as a variety of surveys and group methodologies, group research methodologies, more than ever, I'm hearing over and over again what CFOs want to do is help to put the right resources at the right time to the right opportunities. Okay, in the current environment, when global economic growth is lackluster, certainly it's harder to find and sustain the right kinds of revenue streams. So there's more risk in business investment. At the same time, and we'll talk a bit about this in a moment, products and services are having to be, really, really tailored, and companies are doing an awful lot to better understand sub-segments of their customer bases and drive profitability by finding ways to boost the value proposition for certain segments. And finally, when we get to talking about the close-to-disclose process or financial reporting, certainly CFOs and controllers are just laboring under just a really intensified burden of regulations, and particularly in the area of disclosures. So a lot of that is having people take a look at maybe not transformation of the entire finance organization as a whole, but certainly end-to-end processes such as close to disclose, or as some call it, record to report. Some of the finance improvement initiatives that we've come across, these are some of the more common ones. Really better access to reliable data, to improve forecasting, a lot of effort going on these days to improve the accuracy of performance forecasting. Companies are looking for a lot more collaboration with the financial analysts who sit side by side with them in operations and help them look at scenarios for investing here versus there, at what level of risk. So they really want finance to be more curious and interactive and not just reporting the numbers. Finally, we're hearing a lot about this thing called predictive analytics. Now, what is that? It's as far as I can see, and I'm looking at this currently in a current project, it's very commonly discussed in business operations and marketing and sales. Everyone is talking about big data and business analytics, business analysis, what have you. But it is just beginning to creep into the realm of the Office of Finance, and I find that really interesting. So what is the CFO's role, or the role of FP&A in predictive analytics? Well, what is it? What is this elusive term? Think of a national health club chain. And of course, every January they tend to run a promotion to get more members in the door, and they, cut the membership price in half for a period of 30 or 60 days. But what tends to happen is you'll get a surge of new customers, but after the trial period, perhaps maybe only 30% of them will actually convert into sustained customers. So if you're performing predictive analytics, what you will attempt to do is pull together and filter down and look at data bits that give you clues about what kind of value propositions, or what kind of promotions or premiums will appeal to certain customers at what price points. And this is where finance can come in and play a really helpful role, helping sales and marketing and product development people go after those customers on the margin and offer them packages of value that increase your revenue stream. So again, we will be hearing more and more about this in coming months, but it's really about connecting the dots, finding the signals that customers are giving you, largely through perhaps online behavior, what they tend to download, what they click on, what they say are their preferences. We're going to see a lot more of this. I think it's a very exciting area. I'm also seeing an upsurge in companies taking another look at their shared service models or their hybrid outsourced shared service environments. With changes with, there's talk of some companies bringing manufacturing capabilities back to the U.S. or Western Europe as opposed to emerging markets. As those major organizing models shift, so do the shared services footprints. And so, and also there's a surge of automation that's being looked at by financial shared services managers. So we'll talk a little bit more. I'll give you some examples from my research. And the other thing I'm seeing is finance is taking up the language of process management. What does that mean? You hear more about, oh, I'm a process owner, and I sit between IT and finance, and I'm responsible for measuring the success or the efficacy of a certain process. So those are the quality disciplines and principles that are largely found in many manufacturing organizations, but we're seeing those kinds of things come into the realm of finance. So who's on first? Who's doing what? I'm going to share with you in just a moment some takeaways from a study we did that did a close-up look at 6 companies we determined to be best in class. Now, they may be best in class across several functions or process areas, or maybe just one. But the commonalities among them are kind of amazing. But the problem is most companies have neglected, I feel, and I'll give you data in just a second to argue this case. Most companies have neglected finance process improvement for quite a long time. And there's an awful lot of catching up to do, but there is a lot of enthusiasm as well out there. This slide, I think, really does say it all, okay? What this says is that this is a classic set of metrics from APQC's Open Standards Benchmarking Database, okay? And what we have here are 519 companies who filled out our benchmarking survey and answered the section about the total cost of finance. And that's the all-in cost, personnel, systems, overhead, the works. And as you can see here, the top performers, you know, just beat the heck out of the bottom performers, and the median as well, as a percentage of the cost of finance as a percent of total revenue. Okay, and what that says to me, that 50% or more of companies are willing to tolerate finance operating costs that are 2 times or 3 times more than necessary. Okay, well, you know, why is that? Well, I don't know, but as long as I have been looking at this phenomenon, as I said, over 10 or 15 years, overall the cost of finance has come down. Maybe 15 years ago, the companies that were most efficient were coming in at 2%, 1.7%. So costs on one level have come down remarkably, but the spread between the top performers and the bottom performers kind of stays the same. And that says to me that those top performers are there's something very special about them. And I believe from researching them and talking to them that you find things that are unique, such as an absolute deep commitment to continuous improvement. Finance change is not just a one-off thing. Oh, we're going to put in a new system. No, no, no. They have process owners. They think in terms of process. They measure their efficiency. They're just really dedicated to keeping the momentum up. They do root cause analysis, and we'll go over some of the things that are common among these companies. But to me, there's absolutely no coincidence that 30% or so of companies get it right and push for it, and others don't take the time to really understand the business benefits of investing in finance. Or if they do, the vision is very short-sighted. It's, well, let's take our cost of finance down further, but let's not do something that's going to necessarily benefit the organization as a whole. We might go faster, better, cheaper in finance and make finance happy, but they fail to connect the dots to what the business as a whole needs from them. Another phenomenon, when it comes to assembling the business case for investing, in this case, the close process, I just picked this as an example, CFOs and finance directors would do very well to look closely at the return on investment arithmetic. So again, this data comes from APQC's Open Standards Benchmarking in the general accounting reporting area. And what do we see here? We see there's a direct correlation between the total cost to perform financial reporting per $1,000 in revenue and the speed with which an organization can close its books. So what we have here, the bar on the left, these are the grouping I call the fastest. We looked at the annual close, but in this case this is the quarterly. So the fastest of those who can close the quarter and follow the SEC in 10 days or less. Okay. The laggards, the slowest, are those that take 25 days or more. And it's no coincidence, I think, that the fastest enjoy, quite a significant efficiency advantage over the slowest. So go faster, become cheaper. It's the way it works, is from what I see looking at this data. So where is finance today? We asked people who took out a survey. We said, where are you on the road to becoming a more highly valued partner to the business? And these results more or less speak for themselves. The small majority, 12%, are rolling along with great confidence and learning more and just enthused. A third are getting there, gaining traction, running into the inevitable obstacles, but making progress. The rest have started and are hopeful, and very few said what road. So this, again, correlates with that 8 out of 10 statistic I showed earlier. This really does kind of underscore that there's a lot of movement when it comes to this. What processes are we talking about? Well, according to our survey, the most popular area for improvement is, probably no surprise, plan, budget, forecast, analyze, replan. Secondly, the close, consolidate, report area. Now, again, I found that interesting because in a number of articles I did last year in talking with CFOs and chief accounting officers, you often heard that the close process was just the last area of finance to get a lot of attention. Why? Well, lots of reasons. Typically because the end result, what management saw, what the CEO saw, and what the board saw, and what went to investors looked pretty good, looked pretty tidy, looked pretty nice, all wrapped up in a bow. But what was not visible was the Herculean efforts that went into getting those numbers ticked and tied, getting that package together, getting everything done on time, meeting deadlines that are statutory in nature. But again, as I mentioned earlier, the era of re-regulation we are in is really putting an awful lot of burden on the close process, the so-called last mile of finance. And I am finding a great deal of interest in process streamlining, ways to take risk out of the process, because restatements are just such a horrendous nightmare these days, always were, but worse now than ever, and looking at different automation solutions for workflow and helping to avoid bottlenecks. But not to delve too deeply into that. Next up, general accounting. When it comes to the core processes, AP, far and away, is getting a great deal of attention, and some aspects of working capital management. What is the most important goal? This is what I found interesting as well. When you ask, are you going just to take out costs? Are you going for more process efficiency? Are you going to reduce your number of FTEs? So basically your productivity metrics. That was always the #1 justification for investment in finance. But this data here tells me 72.5% are going for both effectiveness and efficiency. And what is effectiveness? Effectiveness in this context is defined as being a better partner to the business. Better analytics, better decision support, faster, fresher data, more accurate forecasts, more sophisticated modeling of various investment scenarios, And now it's time for our first polling question.
Fantastic. Thank you. A lot of data there. I'm going to go ahead and launch the first of 3 polling questions. Now, if you're here for CPE credit, you need to take all 3 of the polling questions. And I'll leave this open for about 30 seconds. But even if you're not here for CPE credit, well, we'd love to see what you've got to say. It's always interesting statistically to see where everyone is on these issues. So it would be great to hear from folks on all of the polls that we've got today, whether you're here for CPE or not. I will also make note that you can ask questions anytime. We already have a number of questions coming in, so that's great, but keep them coming, and when we get to the tail end of the webinar here, we'll get into our Q&A process. I'll leave this question open just for another few seconds, and then we'll get back to Mary. All right, I'm going to go ahead and close this down, and then you should see Mary's next slide on your screen. Mary, take it away.
Very good. Thank you, John. Let me go back here just one. This report that I mentioned earlier, it's called Building a Best-in-Class Finance Function, and it's an unwieldy 106 pages long. I'll never do that again. But it is just chock full of some really interesting case studies. Again, these are the companies we identified as being worthy of a close-up view and study. Intel, long known as being one of the top finance organizations in the land. Manpower, and again, as you can see, these companies are from a variety of industries. Manpower, big professional business services organization with locations all over the world, multiple, hundreds and hundreds of offices all over the world. Cintas, which is, again, another services operation, big company that provides rental uniforms and all kinds of equipment of that nature, very decentralized, and Discovery Communications, the broadcast channel, the Office of the Controller of the Currency, okay, out of the Treasury Department. They are a very interesting case, and I'll get to them in just a minute. 2 companies who didn't want us to tell you who they were publicly, but I can tell you that one is one of the largest biotech companies, and the other is a very huge defense contractor. So what did we find? I pulled together this model. After studying all these companies and tracking what was common across them, I apologize for if this chart is hard to read, but you'll be able to see it when you get the downloaded chart. But here's the things that I found among all these companies. The best practices organizations, number 1, are all committed to excellence in financial management. And how does that manifest itself? Well, I broke these dimensions down into 2 elements. They're either aspirational dimensions or foundational dimensions, okay? And they're marked here on the chart as F1, F2, F3, A1, A2, A3, A4. And this is just kind of a pictorial to get a good conversation started about what exists in best practice finance organizations. So 2-1, let's take a look at this for a second. The foundations, these are conditions that really must exist, just absolutely have to be in place to ensure that targets for financial management processes, efficiency and quality are always met. You just got to get the basics done, and they have to be done at a quality standard that is unconditional. Secondly, process owners are able to pursue productivity gains each and every year. So organizations that have successfully moved up the maturity curve have organizational structures that are aligned to their internal customers' needs for both transaction services and decision support. So for some companies, global business services model for providing transaction activity to the business, that may make sense. For others, it does not. There's no one organizational model that fits all. It depends on the culture, the people, the strategy, and so forth. But at the companies we studied, the way finance is organized is very much aligned with not only the overall strategy, but aligned with the goal of meeting the needs of internal customers. As I said earlier, there's also an emphasis on continuous improvement, with a structured methodology, very, very structured methodology for change. And you tend to have people who learn, who are trained in change management technologies. I'll show you some of those in a minute. Also, finance has a clear roadmap for what it's going to do to align with the organization as it changes over time. Now, the aspirational dimensions are really characterized, I'd say, by clarity and commitment. Okay? There's a vision statement. Some call it a charter, and it's a very powerful mode of any course. It's not just a statement, a mission statement that gets stuck in a drawer or hung on a wall. Employees at these best practice companies really do truly in their heart of hearts know what stakeholders and shareholders expect of them. And their leaders provide them with the tools and the skills and the wherewithal they need to excel. So there's very much clarity around what it takes to be an effective partner. High level of awareness of business strategy. You don't tend to find finance people who are disconnected from strategic imperatives, and so forth and so on. A deep commitment to training and absolutely a deep commitment to finance talent development. You don't hear things like, oh, we have to slash our training budget or no training this year. Absolutely not. Let's take a, I mentioned the finance charter, and I just want to share with you the one that Intel uses, because I have long thought that this really stands out. Just really quickly, I won't drain it too much, but look at number 2. Number 1, of course, is the classic stewardship role, but number 2, finance at Intel is motivated to maximize and grow profits by exercising business expertise, independence, influence, and leadership. Well, it sounds like a collection of nice words or cliches, but in the case study, which we go into in depth in the report, it really talks about how Intel goes about this. Number 1, Intel Finance measures, tracks each year how much it claims to contribute directly to return on capital through a variety of efforts, whether it's decision support or efforts in the realm of working capital management or treasury or what have you. But they track it, and people know that they are part of the engine of business. They are not just the accounting folks, you know, in the back of the bus. And so forth and so on. Efficient world-class service, protect shareholder value with effective risk management, develop finance professionals. Again, I found these kinds of things at all the companies we studied, but Intel's really jumped out at me. Another charter that I thought was effective comes from the Office of the Controller of the Currency. As you can see here, anticipate customer needs through a better understanding of their business. Again, the case goes into real depth of what that is all about. But I'll show you some examples from OCC. Here's just a quick rendition from the case study at Manpower Group, how they did a gap assessment to figure out where they were, what were the value drivers in their mind of finance excellence as they saw that it needed to be to meet their company's needs. What were the value drivers, where they stood now, where they had to get. So this is kind of a classic spider chart that measured the importance, the effectiveness, and what they call a 3-horizon objective for finance transformation. And that was a multi-year effort. It involved standardizing on accounting and reporting procedures, policies, and systems worldwide, while at the same time allowing effective local discretion over, you know, which drove local financial reporting and statutory disclosures. Here's another thing. I don't expect anyone to want me to read this in depth, but it just shows you how Manpower filled out a framework involving, you know, straightforward people, technology, process, and organizational design, and what their vision for those elements meant in terms of transformation. So in process, They wanted a focus of time on planning and decision-making, not transaction processing. It's interesting. Our continuous data gathering by APQC still to this day shows that easily 3/4 of the work of finance is spent on transaction-based processing. Put another way, only 20–25% of finance's time is spent on analytical work. And that's been true for as long as I've been looking at it, and it's still shameful, I think. But companies like Manpower are taking a very hard swipe at that. Here's a look at some of the performance levers you'd find at the Office of the Controller of the Currency. And you know, it's funny, when we were interviewing them and documenting what they do, it was easy to forget that they were a government entity because they think like a commercial operation. They have clear goals for annual cost savings using their Lean Six Sigma. The annual goal is $600,000 in savings. So they have a Lean Six Sigma program with 14 green belts, 1 black belt, and these people manage the process improvement initiatives. They review their submissions bi-weekly. They select projects to work on, personnel. They have assigned personnel to staff these improvement projects, and they identify project mentors. Again, I'm not going to go into too much depth. It's in the case, but you see an organization like this using things like, well, they're very, very avid users of benchmarking in their financial management organization. They've been participating with us for over 6 years. And the other thing they do I find interesting is they want to understand best practices of organizations that are not so much government entities, right? So they recently asked us to point them to companies that were doing a great job in the close to disclose process. And I said to myself, wow, they're not in the same boat. They're not required to file quarterly with the SEC the way an industrial company is. But in fact, they wanted to understand what was best practice in monthly financial performance reporting. So they were looking at companies that are known to do that really well in the public sector and in the private sector. Across all these leaders, you hear every single case, I swear, was talking about either Kaizen action teams, change management expertise, finance process owners, everyone talked about Six Sigma. They benchmark, most of them benchmark with us. They have tools like balanced scorecards, very, very much into dashboards and metrics. Let's take a look for just a second at some of the, let's take a look at the payables processing and payments area, because I think we have at least two of our cases delved into that. So what you tend to find there is a very much strong intention to leverage shared services, and number one, make shared services very much a vibrant and vital and intelligent seeking place to be, not a culture of back office, we don't count. They tend to have a roadmap for what they're going to outsource when they're going to insource. A lot of them have figured out the ERP strategies that make sense. You see a lot of process and workflow automation, particularly in accounts payable. Suppliers driving as hard as they can to get as many invoices coming in digital form, whether use of third-party invoice digitization or not, but very much have made a case for automation of the payables processing activities, and find that what it does is not only increases your intelligence about cash flow and accrual reporting and all this, but you can get to the root cause of, say, PO match failures, PO invoice match failures, which are the source of a great deal of manual intervention and labor costs. Just quickly wrapping up here, here are some of the things you can benchmark in the area of AP: cycle time in days to approve and schedule, T&E payouts, percentage of disbursements that are first-time error-free, discounts taken, invoice line items paid on time, invoice line items received electronically. That's a biggie. You see there's a direct correlation between when you get up into over 80% of line items processed electronically, you see a severe drop-off in process costs. So, and you can also look at the overall process cost per $1,000 in revenue. Just real quickly, a snapshot. I just pulled a bunch of metrics. Again, I just pulled AP, but I have metrics on general accounting, close to disclose, accounts receivable, T&E, payroll, and some in fixed asset management. But you just look here. Look at the difference between those in the top and those at the median. Now, the top quartile are in the sample all of the companies that perform better than 75% of the rest of the sample. Okay, so they're in the top quartile. But look at that, top 50%, number of invoice line items received electronically. And if you look at the top decile, you'll see that number go up closer to 80, 85, 90%. Personnel costs, total costs as a percent of revenue, quite a difference. The personnel costs are quite a difference. Number of invoice line items per FTE, a big productivity boost for those in the top, again, thanks to automation, most surely. In summary, I could go on and on. I'm passionate about the subject, and we have quite an ambitious research agenda for 2013, continuing to push the string on a number of these things. But in summary, I just want to underscore the need for insightful decision support, and that is what is driving an awful lot of this activity. So it helps to reassess your levers of financial process and performance, especially talent, culture change, or if you can do anything to influence the culture of finance, to prompt people to think in terms of service delivery. That goes an awful long way. Finance costs should not be higher than necessary. There's just no reason to tolerate that. And for anyone who just wants to know a little bit more about how benchmarking works, here's a link for that. And with that, John, I hand it back to you.
Great. Thank you so much for that. We're going to go ahead and launch our second polling question here, which, like the last one, we'll leave out for about 30 seconds. And once again, if you're here for CPE credits, you need to take all of these polling questions. We have the third one that will come up right at the end of the hour here. But even if you're not here for CPE credit, we'd love to see where you stand. We'll go ahead and take this moment to remind folks that you can ask questions at any time. We're about to get into the Q&A segment of today's event, and Mary will be taking all questions. So please feel free when you're done taking the poll here to drop us your questions about today's topic. I'll leave this out for another 5 seconds, and then we will get into said questions. Okay, I'll go ahead and close this down right now. And let's go ahead and jump into the Q&A portion of today's program. First question, on the total cost and revenue slide, you suggest that the top performers don't invest as much in finance, or on a percentage basis, their cost isn't as high. Does that mean, I mean, you can read that a number of different ways. Is it that somehow or other the top performers actually aren't putting as much money into systems and processes, and there are other performance measurements that are driving them to great performance, but not investment in finance? In other words, you could see that as, oh, these folks are being really efficient, or these folks are cheaping out on their finance investment, and they're just really good in whatever the measurements are, the other measurements are of success for their company, and therefore there's not necessarily a correlation between the two. So can you clarify that a little bit, Mary?
Sure. I mean, I think that's an astute observation. Certainly, there are some that cheap out on finance. But then you have to, if you look at, I like to look at it this way. I like to look at companies in that top performer bucket and then look for signs that that is not the case. All right. So when I interview companies or study companies and ask them questions about their cost, if they are also showing other signs of top performance, such as cycle speed, and they're also indicating best practices, such as in good investments in dedicated software applications, or, you know, I see that they are, or they're talking about, oh yeah, we're getting away from obsolete paradigms, such as running the business with waving an annual budget around for 10 months. If they're doing things like moving towards driver-based forecasting. So there are a number of clues that help the genuine best practice companies pop out. But you're right, it's certainly the case that someone could be cheaping out. But I tend to find when I look into those companies, I go into that bucket and say, who's over here in this top quartile? You know, you tend to see companies who are known for embracing continuous improvement in a genuine way. And keep in mind, APQC has other practice areas. We look at human capital management processes and supply chain management processes and this and that, and we have a sense of who's really doing it right.
Okay.
So I'm not sure if that's satisfactory, but that was an astute observation. Yes.
Well, you know, one other just follow-on question to that would be, just from my perspective, how are companies determined to be the top performers? Is it based on EBITDA or stock market performance? Or, in other words, can you help us understand how that performance is measured? Is it just performance of the finance organization or performance of the entire company's certain results? And now we're going to take a look at the finance perspective based on full company success rates.
Well, if I'm publishing a report and singling out 6 or 7 companies, on the one hand, we'll look at their quantitative metrics, okay? So we'll look at their process productivity, which is what we're all about, okay? Labor productivity, cost, you know, speed. Who is faster, better, cheaper? That's just one dimension, though. As I said, I'm also looking for signs of a mature management in finance, dedication to talent development, okay, things like that. At the same time, if I'm going to publicly, you know, hold a company out, I'm going to do some work and make sure that the CEO hasn't just been thrown in jail or something like that, or that they're not the laughingstock of Wall Street, or they've had a huge product recall. So, you know, you're generally looking for widespread corporate performance, but not necessarily. Having said that, I don't weigh either market capitalization or earnings performance as in a particular light. Yeah.
Okay, so it's more broad-based than that.
Yeah.
Why don't we go ahead and move on, because we've got a whole pile of other questions here I want to get to. What have you found to be good KPIs for the FP&A group? You gave us a little taste of AP, but FP&A, which is something that every finance organization does, what are good ways to measure oneself there?
Oh, very interesting. I did a report last year called The 7 Essential Qualities of FP&A. And off the top of my head, I created a model, another one of my lovely little Starburst models. But that report is free to non-members. Most of our APQC content is for members only. We are a nonprofit, member-supported organization. But that particular report is on our knowledge base, our website, and can be downloaded by anybody. It's called The 7 Essential qualities of a winning FP&A team, and I would say that there's a number of things. One, a basic requirement, table stakes is, a very, of course, mastery of management accounting and core finance. Secondly, a very keen understanding of how enterprise systems work, and how data flows through ERP systems, and so that real creativity can take place in terms of grabbing data, extracting data, and working models. So of the other 7 things, one was curiosity, just plain curiosity. There's a big debate going on about whether or not a good accountant can make a good FP&A executive, and the judgments are sort of mixed on that. So those are a few of the things. I suggest people take a look at that report.
Great. Thank you for that call out. The cost to close metrics that you showed were very insightful. How was that measured? You had those ranges with certain, X cents to Y cents for top performers. And
those were, that is the cost of the process itself. So all the activities that we define as being part of the closed process, measured in terms of per $1,000 in revenue. Now, I can find, and so how do we define? I'll have to pull up my notes again to see if you really want to know. Okay, how we define perform financial reporting. That's the process. So that involves compiling financial data, developing corporate or business unit financial reports for management and board review, preparing consolidated financial statements for public release, and filing official documents with regulators. So you take all the costs of that and look at it in terms of per $1,000 of revenue as a simple way to do it. Okay?
Okay. Let's see. So next question up. For the close process, can you tell us whether top performers book to budget for the first 2 months of the cycle, for instance, and then do a hard close in the 3rd month of the quarter, or are there any insights into what those top performers are doing in order to drive that top performance?
I don't have an easy answer to that one. I think it really, if I had, the only way I can answer that is I think it depends on the information needs of the organization, right? Years ago there was such a big deal about, Cisco made a big deal about being able to close daily. Well, why did they need to do that? Because the nature of their business, the volatility of electronic components, for one thing. Other companies don't need to close at that cycle time. So I think it really depends, is the answer. Sorry.
I was actually at Cisco in finance during that we can close any day of the month era. You're bringing back nightmares. Thank you. Next question. You mentioned predictive analytics being used more frequently in finance, at least talked about more frequently in finance. And this questioner, and I would echo this myself, says, I haven't seen as much traction in the finance department as I've seen in other areas of the business. Certainly I see a lot of predictive or more predictive analytics around marketing, around sales, et cetera. What solutions are you seeing emerge around predictive analytics use within the finance organization? Yeah,
I'm seeing that too, that it's still very, very early days for finance to figure out their role. Certainly the operating and the marketing sides of the business are all over this. But here's and I am fielding a survey on this very, very shortly to find out more. But in my kind of digging around and talking to people, here's one example. Just last week I interviewed a CFO who is working side by side with their product development people. Now they are a big professional association, so they sell courseware, they sell conferences, they sell books, all kinds of content to meet the professional development needs of their very highly technical customer base. And their customer base tends to be going through a big surge right now. So they've got to figure out, gee, we've got our customer base is just exploding with need. How do we know what to put together in terms of a value package? And first of all, they're saying let's look at different segments of our customer base. Okay, there are those that renew on the very last day of their membership. There are those that don't renew, and then we have to fight to get them back. Then those who are very prompt about renewal. Let's understand the different behaviors of those different groups and see if we can put together. So in this case, the CFO he's talking about, using Google Analytics. Okay, so they use Google Analytics to understand the types of behaviors witnessed on their website, so they can get a better clue about who's downloading what, who needs what, at what price, and so forth and so on. That's where the CFO is helping to design products and services with intended margin in mind. Okay, you're seeing more of that. Another example right now involves Starbucks. I read the results of a conference call that they had with analysts recently, and people may recall that in around 2007, Howard Schultz had to come out of retirement because they had opened a whole slew of stores in the U.S. and within a year had to close, 1,000-something stores, and it was a real debacle. So now they're back on a growth spurt, and they're announcing major expansion in Asia and another big store expansion in the U.S. But this time around, instead of just having revenue growth as a strategy with no guideposts, no analytical guideposts for what profitability should be expected and how do you know where to put a store. These days they're working with something called location analytics, which is pretty sophisticated stuff, to see ahead of time, to put together the evidence, the data ahead of time about where to locate stores and to ensure that profitability targets are more likely to be met.
Gotcha. Okay, great. And I hate to say it, but we are running towards the end of our hour here. We've got a couple pieces of housekeeping. So we've got a couple of questions we didn't get to. Mary, is it okay if we work with you after the event to see if we can get some of these questions that we didn't get to answered and maybe also posted on Proformative.com for all to see?
Sure thing.
Wonderful. Thank you. So just stick with us here for another minute. You will be prompted to take a short survey after this third and last polling question, which is going to come up in just a moment. Also, of course, please join us at Proformative.com to ask any additional questions you may have and continue this conversation. And as I just mentioned, hopefully we'll get Mary on to help us answer a couple of those questions online. And certainly if you have any CPE questions, please contact Chris Brower. You can see her email contact information right there. One other item of note, Proformative has a, speaking of finance technology, which we've mentioned a number of times today, we have a big finance technology conference coming up in the San Francisco Bay Area on March 20th. You'll be able to see over 20 different platforms, everything from ERP to budget and forecast and treasury systems, BI systems. The idea is to be able to see it all under one roof so that you can see what's going on in the world of FinTech in one day instead of having to go to dozens of separate events. So in the post-event survey, not only can you request connection with Mary, but you can also request to be registered for this event at the click of a button. So we're happy to help you out with that, and we'd love to see you there. Now let's go ahead and launch the third and final polling question right now. And once again, we'll leave this open for about 30 seconds. And once again, even if you're not here for CPE credit, please give us just a few moments to answer this question. It's always interesting to see where we all stand. And I'll leave this open for another 15 seconds, and then we'll pop right straight into our post-event survey. And actually, while I'm waiting to do this, allow me to thank Mary for your time and insight today. It was great having you on board. We love having you involved with Proformative, and thanks so much for bringing all this wonderful information today.
It was a lot of fun, John. Thanks for inviting me.
Oh, you betcha. Our pleasure. Also, I'd like to thank everyone who took time out of their busy day. We know how crazy things are for everyone these days, just not enough hours. So spending an hour with us, we greatly appreciate, and we hope you found it valuable. We hope to see you again at another Performative event or at performative.com. And with that, I'm closing down the final polling question, and we will go ahead and jump right into the exit survey. This will take less than 60 seconds. We greatly appreciate your sticking around for it. Take care all. Have a great rest of your week. We hope to see you again soon.